Welcome, everybody, to our July instance of our Enduring Planet and Friends community series, our finance series. This series is produced jointly by Enduring Planet and Lupine Finance and sponsored by Wilson Sonsini. So thanks to the team at WSGR. We've got a really special event for you guys today. We have Andrew who's going to introduce himself in a moment. And we're doing kind of a unique format. It's more fireside or totally fireside as opposed to a panel. So Andrew's in the hot seat, and we're going to make him feel hopefully just mildly uncomfortable today. Um, for those of you that have joined us in the past, these events are meant to be very tactical and interactive. And so not only did we collect potential questions from the audience ahead of time, which we're going to go through later in the session, but we also would love it if you are very active in the chat. So feel free to ask whatever questions you want in the chat. We will respond to them live in some cases or just add them to the discussion. This event, obviously, as you now can see, is recorded. We will also produce a summary of the event sometime in the next week, and we will also post that to the Enduring Planet website along with the recording. So, Hannah, anything I missed about housekeeping before we do intros?
Not at all. Just to say that, folks, this is a little bit of a look forward. So what for the next 12 months of planning? And some of your pre-submitted questions asked things like, how does the Fervo IPO change sentiment in the landscape? So while we appreciate those questions, we're also asking them ourselves, and we have put together a New York Climate Week event. So make sure to follow the Luma calendar for all of these future webinars and come register for the waitlist if you'd like to come hear from the CFO of Fervo themselves and many of our other amazing speakers who are coming together for New York Climate Week. But today, Andrew, thank you so much for being with us. This has been such a delight preparing for this. We're really excited for the conversation.
Awesome.
Likewise, thanks for having me.
All right. Well, why don't we do quick intros? I guess I'll start. We'll go to Hannah, then we'll go to Andrew, and then we'll kick off our questions. For those of you who don't know me, I'm Dimitry. I'm the co-founder and CEO of Enduring Planet. Enduring Planet does two things in the climate ecosystem. We are a lender, so we provide working capital to climate companies with credit-worthy contracts, whether those are government grants, government procurement, corporate procurement, doesn't matter. If you have a good contract that you need some working capital for, we can lend you money. We also do fractional FinOps support for climate companies. So we basically own your finance back office, and we work with nearly 100 companies and nonprofits today. Hannah, take it away.
Very quickly, I'm Hannah. I run a company called Lupine Finance. We're nearly 10 clients strong with six different CFOs in the pocket. We are the complement to Dimitri's very smart team over at During Planet. We sit in the strategic sleeve of CFO work. So we often support with capital formation and fundraising, interfacing with investors like Andrew, as well as kind of directing the FP&A and strategic planning for companies across the hardware and climate tech space. And with that, and no further ado, Andrew, you've been at Obvious for a while now. Tell us more how you got into it all and what you're up to.
Yeah, great to be here with you too. I have been with Obvious for coming up on 12 years now. The firm was started, I think, a little before that, about 13 years ago, with the simple belief that exceptional founders trying to tackle systemic challenges in the biggest markets in the world were going to develop outsized impact and outsized alpha. And we do that, we invest in those companies across three big pillars: human health, planetary health, and economic health. And I lead the economic health, I lead the planetary health, which is for the most part climate, a lot to do with edge intelligence and robotics and other areas, material abundance as well. But my focus has been climate since day one. And before that, I was a founder in the climate space for over a decade, almost most of the time in the solar space and some energy storage as well, but got involved in solar in the very, very early days, at least, of the modern incarnation of what solar has become, starting in 2003. So I hope we can delve into some of that and go into the Wayback Machine for sure.
Well, with those intros out of the way, I think we'd like to start this fireside, sans fire, to maybe lay out what the landscape in the market looks like today. And this is just so that we can sort of all align on where things are at, and then we can talk about where things are headed and how various founders can navigate that dynamic. So, Andrew, maybe just give us like an honest and candid state of the capital environment in climate right now. Obviously, you have a view into equity more than anything else, but if you want to comment broadly, equity, what you're seeing in debt, what you're seeing in project finance, just give us like a 3 minute overarching perspective.
Yeah, sure. Uh, this is a little tricky for me because I've been in this realm for 25 years and I've seen, a couple of cycles now in the climate world and energy, mobility, electrification. And each time there is a dip and a cycle and a boom and a bust, but each time the chart is going up and to the right. So we have to sort of contextualize it maybe in that 25, or you could go longer if you wanted, 25, 30-year time frame, because things are going really, really well by a lot of measures, and yet there's some ebbs and flows. And so to me, the current state is more capital is in the system than has ever been in the system before in a lot of different buckets. Probably the one bucket that's seen a real pullback is U.S. federal government money going, gushing into the climate space. That is going through a substantial withdrawal, although not 100%. And so I think that. I know people are feeling like there's a tightening in early stage climate venture. There technically are more dollars to be deployed than there have been in the past. And I think that what a lot of people are seeing is just with education, with changes in government subsidies, I think a lot of investors are becoming a lot more picky and narrowing the scope of sectors that they're focused on. And some people are feeling the heat in that way.
Yeah, and I think, I mean, we can come back to this. My sense, and correct me if I'm wrong, is that there's also this kind of concentration dynamic that's playing out in the market where despite the large quantities of money moving into the space, it's going to fewer players and in like a more limited subset of industries. Are you seeing certain sectors face
Yeah,
kind of greater headwinds or pressure within climate?
sure. I think you're right, Dimitri. I think that we're seeing actually like in venture writ large, we're seeing concentration, right? So we're seeing some of the biggest, quote, hottest companies getting a extraordinary portion of the total committed dollars. That's true for Anthropic and OpenAI and companies in the broad AI world, and it's true in climate when we look at Commonwealth Fusion or Fervo or our company Zanscar or others. There's a lot of concentration of dollars into those presumed winners. So that is also true, as you alluded to, that this is happening sectorally. So things like direct air capture are losers right now in terms of available capital, and things that have anything to do with data center scalability and data center efficiency and data center build out and data center are winners. And we're there's really, really good reasons for that. But it's a very exciting kind of shift that's happening, and not everybody's going to win with it.
There's
All
a
right, so everybody should just go and drop what they're doing and work on data centers, right?
Well, I
I'm
mean,
kidding. I'm
everybody,
kidding.
no, but everybody wants to, say I'm an AI company. I think in the world of climate, there is some, we it is valuable to keep track of, if not entirely follow the money. And the amount of money going into the scale up for our current AI obsession and likely transition is so extraordinary, it's hard to conceive of for a lot of people.
Mhm.
It's much, much bigger than the internet build out boom. It's bigger than the Manhattan Project. It's bigger than, pick your major great works projects in the US and elsewhere, and it's bigger than all of them, in some cases, most of them combined.
yeah. It's like concentration while growth continues to happen, right? The venture capital asset class, regardless of whether or not you're in climate, was 512 billion in 2025, and it's already 331 billion just in the first quarter of 2026. So there is a industry creation happening, and some of our typical indicators like how big is funds two and three, those are lagging indicators. They take years before they're announced, and those announcements, follow 6, 8 months of when that money actually moves and allocators have chosen it. I'll let Dimitri talk about upstream, but downstream, Andrew, likewise, there's a tripling of private credit happening in the market as bank regulations have stifled some of that. Can you opine on what you're seeing change for follow-on rounds of companies? Is there a steeper drop-off in the failure rates from, call it Series A to Series B that you're seeing, where the market sectors pick winners and losers? Or is there a proliferation of options now for those companies that formerly were on a venture growth curve and are starting to diversify into more complex financing structures to take advantage of private credit?
Yeah, I mean, other than project finance dollars, I have very little exposure to private credit in the traditional sense of what a private credit fund today is offering. So I haven't seen that much. I know you may be able to help people get exposure to that, and I think that's a very interesting kind of recent development. What I am seeing, we have a number of companies who have dual structures where they can have off-balance sheet financing through project finance of major assets, and that could be an EV charging system for trucks with a company like Forum Mobility. It could be power plants with companies like Zanskar. So I am seeing availability of that money, and it's similarly gushing in, especially for areas where we're talking about transmission, energy development, data center build-outs, et cetera.
Yeah, I think I don't know, and maybe Hannah, you can comment, but my sense is that as you see this like concentration of VC money in certain sectors, other other sectors are responding by looking at other capital options more than they did in the past. And so we're like, in our case, we're seeing a lot more demand for our credit products from companies that have contracts. Maybe they don't have that like crazy 10x, 100x growth curve that people are expecting of AI, so they can't raise venture in their market. So we're seeing, and I mean, I think that the maybe the bigger challenge in the space is that there honestly isn't enough private credit to serve the needs of all
Yeah.
these companies. And so that's like a big need and a big gap that we see and are honestly trying to take a stab at, but like it's so large that not it's not like one fund can solve it, right?
Yeah.
Uh,
The implications we're seeing at a lot of the Series A stages are that, private credit by its nature just it cannot flex itself to have the risk tolerance for things like technology development the way that, larger growth rounds have historically been able to take on from an equity standpoint. And I don't think that structurally is changing at all, right? We've seen that with, many folks have tried and done pilot funds, I would say, of development capital and some of these other precursors to project finance and intentionally taking on those technology and engineering risks. It's just a hard thing to fund. However, Andrew, like what one of the things that I think is we could do some myth busting here. A lot of folks are saying climate is really hard. There's a huge headwinds, and now the LPs are shifting, the allocators are shifting, and it's going to be a lot harder for funds to raise funds two, three, four, and five, right? You've kind of made it past the other side of that curve where you're at. Congratulations, huge testament to your work. But tell us a little bit more. Give us a bit of a tactical advice here. If you were a founder whose fund is saying, I'm out to raise fund three. How much hedging should that founder be doing? Should they really
Yeah.
be trying to understand that process, whether the fund is past its first close? Should the founder be diversifying with net new investors, or how should they be thinking about that?
Yeah. First of all, I think we were in a great position when we started Obvious. Emerging managers were sort of the trends, like early stage, early funds, fund one and fund two. And that was really interesting to a lot of LPs when we got started. So we had great timing. Now, seasoned four, five, six kind of funds are more trendy, and people are just valuing that experience, and that happens to be where we are. So sometimes timing just really helps you out in any given realm, and it has certainly helped us out along the way. So some of this is just timing, but today it is true that it's harder for new funds unless they come spun out of a very, very successful fund and they're known investors to raise the first fund, raise a second fund, and maybe even raise a third fund. So it's harder, but we should put it in relative terms. 4 years ago, it was, or maybe 5 years ago, it was really, really much easier. It's never easy to raise a fund, but it was much easier. And so we are maybe just going back to a place of normalcy, but it's not about climate. This is just about venture capital. The same is true across generalist funds as well. Unless you're spinning off of a big brand and you yourself have a big brand, or you're a really, really well-known founder who's done quite well and is staking a chunk of the fund themselves, I think that it's hard in venture to raise that second fund today as well. So what I would put general statements out there, which is you should always be aware of how successful the investor, specifically the person, but the fund and the investor that you're working with really has been and what their reputation is, mainly with other founders. But that should be a proxy for their reputation with their LPs. And it's perfectly acceptable to ask an investor, where are you in your fund's life cycle? Am I going to be the last check you write? Am I going to be the first check you write? And if you're the last check, where does the next check come from? Are they allowed to make investments across funds? Will they have reserves? Do they have opportunity funds? And there are a lot of different answers. There's not one right answer to that question, but you want to know. And if you're late in a fund, that will have implications, or likely will have implications for where that next check for the follow-on money comes from. Or if you get in trouble and you need a bridge, where does that money come from?
Do you, maybe this is like not a safe question to ask, but do you feel like VCs are generally candid about their like future follow-on capabilities with their founders? Because obviously, like if I'm a founder and I come to my investor and I'm like, hey, where are you and your fund, and are you going to write me the next check? Um, if they say no, I'm guaranteed to go look elsewhere, and now they're going to lose out on that allocation. Like, do people hedge? How should people like break through the?
Yeah, I mean, I have a couple of suggestions. Uh, yeah, first of all, ask the question of other people.
Hmm.
They'll give you some references. You'll probably get some secondary references. Ask those people, hey, where are they in the fund? You can also look up when was the fund raised, and if it was more than 3 years ago, you sort of know they're toward the back of that investment period. But I don't. I think it'd be really unfortunate if somebody was actually dishonest with the answer to that question. But the answer really has to be either we have reserves set aside or we don't. And if we don't, they might say we'll do special purpose vehicles, SPVs, or we have an opportunity fund that's got a lot of money left in it. But you can ask specific questions. How many more investments will you make out of this fund? That's usually an indicator of where they are in the
Yeah,
cycle. And I think you do have to. It should factor in, but it shouldn't be the only thing. And
true.
then, of course, something they may not be they won't be dishonest about, I hope, but they might not lay out for you very specifically is we may have reserves, but we may not give it to you if we don't think you're doing a great job. So let's all be honest about that too. We have to make tough choices sometimes and not follow on.
Do you think it's worth then asking the question like, okay, you have reserves. What needs to be true for us to
Yeah.
access those
Yeah,
reserves?
I think that's a great question, Dimitri. They are asking, they are writing that down anyway, usually in their deal memo, saying this is what it would take, mainly like for this company to be successful, not for us to do a follow on, but just for it to be successful, and at which point we would hope we could follow on. And so
Got it.
uh, it's a little bit like getting a new job and saying to your new boss, like, hey, let's work on the 6 month or the one year OKRs to determine what you believe is going to be a measure of success. And hopefully if we agree on that, that'll be great. And I get a bonus or I get a gold star or whatever. It's the same thing here, right? If I do those things as a founder that you and I are agreeing is the definition of success, I would certainly hope that I could count on ongoing support. And that's when you can ask, you know, what's your ongoing support capacity and how do you define that? And hopefully they'll, if they are toward the end of the fund, they'll say, we're halfway to raising the next fund or whatever. But those are valuable things to dig into with your early stage investors.
Those are super meaningful questions. I hope the room is taking that away as asking those questions, even if they feel pointed, is actually showing you have a lot of empathy for where your investor is at. They usually appreciate that more than not. Chris asked a question here about whether, with this total venture capital shift in the asset class, whether particular LPs are behaving differently. Maybe Andrew has a take, but I think that every founder needs to appreciate every LP is slightly different, and an institutional pension fund, an insurance company, an endowment. They are subject to many things like the denominator effect, where they're very, their allocations toward venture, which is an illiquid private asset class with a lot of risk but good upside, is is dictated by how well public markets may be doing and what that allocation of their portfolio looks like. And when you talk about opportunity front funds, you're talking about selling potentially equity in your company through your venture capitalist up to their limited partners. And they can do that through direct co-investments. They often have those co-investment rights. Maybe it's a distinct opportunity fund for those follow-ons. Maybe it's just the reserves. But anytime that's happening, your venture capitalist is communicating why you're successful, why you're the winner, why you're doubling down. Helping them do that in a way that signals where the company is going, why it's successful, also helps any LP, an institutional or a family office, think about what bucket you fall in. Sometimes, if you're a stable cash flowing asset class, and you won't have venture like upside, there's a way to sell that to LPs, right? There can be LPs who want that exposure through a special purpose vehicle co-investment in the project itself. You really just have to know what their appetite is and what you're selling, and don't try to sell something that you're not capable of. Maybe to that vein, one of the things that I've been surprised by, not surprised by, but interested to see in the headlines recently, there's a few companies out there thinking about SPAC mergers. We've had some successful IPOs, but there's some indications that maybe the public markets window has cracked back open. Andrew, I'd be curious your take on that and whether you're looking at that as real signal or if there's a bit of noise at the moment.
Yeah, I mean, for first, just on the LP front, I would say there are trends in the LP world and in the GP world, in the venture world, that capture people's attention. Like it could be healthcare for a few years, it could be SaaS for a long time. In the last couple of years, or before Trump was elected, I think climate was getting a lot of momentum as a trendy area, but at the end of the day, what we believe and where we really align with a lot of LPs is they want to make money and they want to do it in consistent fashion. And so we suggest that they don't index to one category, climate, healthcare, whatever, and instead look for a blended approach. And that's typically what LPs do in venture. They might put together a portfolio of their own where they do healthcare only venture fund and a climate only venture fund and get that blend, or they might go to generalist firms or multi-thematic firms like us, where we're in these different buckets together. And so we don't see, I really don't see like a LP wide kind of step away from the climate world. I think some people who were heat seeking on it maybe pulled back a little bit, but the dollar impact is not, I don't believe it's substantial. And then on the SPAC front, I mean, I'm a fan of old-fashioned IPOs because they cause or they mandate just an extraordinary amount of scrutiny and rigor in terms of diligence. And SPACs, by definition, just have a lot less of that. And I think that that is, I believe that that is part of why the SPAC track record has been so poor versus public IPO, traditional IPO pathway. So we've had companies SPAC, we've had companies go public. I continue to believe that if the window's open, you really want to go down a traditional path. And I do think it is open really across the board, across categories. There may be some areas where the companies are not ready, but I do think that there's a real receptivity, particularly when it comes to things like energy and data centers and true high scale AI.
All right, now that we've laid out the landscape, let's get into tactics. Because I think that's what most folks here are for. They're like, well, okay, so now what? Right? And so I guess I'm curious, maybe let's start with Andrew, across the like VC landscape, how are you seeing the terms of financing shift as the universe evolves, right? So like what should a founder raising in the next, I don't know, 12 months be prepared to see that maybe wasn't common before?
Yeah, I'm not. I mean, there's probably different answers for different stages, Dimitri, and certainly different sectors, but
Yeah.
I'm not seeing any radical shifts. In the past, when I was a founder, there were some downturns where a lot more liquidation preferences were showing up. There were sort of crafty legal structures that were tranching financing and other things. And I just don't think we're seeing that for companies that are showing real scale, who are in really, really big markets and have that beautiful combination at the CEO level of missionary and mercenary, that really want to build something massively scalable, but are doing it from a deeply mission-driven perspective. Whenever we see that in any of the categories in which we invest, if the market is big enough, we're not seeing a degradation of terms. And in fact, a lot of times we're seeing real enhancements of valuation in the favor of the startup.
Mm.
Mhm.
I'm going to weave in a few questions that came in through registration about mechanisms here. Are you seeing any shift away from safes from early stage investors?
No.
And how do you evaluate safes or convertible notes when a founder is not willing to provide a valuation cap or when the valuation maybe seems a little bit too rich, but
Yeah.
is receiving other interest in the market right now?
I mean, look, everything's a negotiation, and a company is worth what somebody's willing to pay for it, and that pay for it meaning all the terms and the valuation. We don't have specific rules. We're really not in favor of safes. When we invest in a company, we want to own shares in that company, and if we're going to join a board and be part of the responsibility of that business, we want to be shareholders. So we tend to get very prescriptive in the use of safes if we're going to do it at all. But really, the preference is to use shares. And I guess what I would say is you can everybody can get sort of crafty in the way that they want to manage that process. But the reality is, what really matters is how much value you're creating, not just valuation over time. And that comes in the form of multiple years of financings that end up at a blended price at the end for everybody.
Yeah, helpful. Thanks. There's a question here in the chat that I think is very pertinent because as we've talked about this evolving venture landscape, there's kind of a bifurcation in venture in some ways. I'd be curious your opinion on this, Andrew. There's a bit of the become $1 billion asset manager, grow very, very, very big as a venture fund. And this question in the chat is asking, as that happens, does the definition of what is venture backable and potentially a fund returner, has that become a lot narrower? And if so, do we think that the impact of the fallout implicates companies that are maybe they were formerly fund returners if we thought about AUM 5 to 10 years ago, but they certainly aren't now,
Yeah.
especially against the velocity of revenue we're seeing in AI models. And then there's the other half of the venture industry, which is kind of doing the cottage industry like super well, right? They're keeping AUM at 50, 75, 100 mil, 150 mil or lower, and just repeatedly rinse and repeat. Zal Billamoria over at Refactor is a good example of that. Solo GP, been that way for a long time. We've built Planeteer to be disciplined in that way. But Andrew, tell us a little bit about how you have thought 12 years with the firm, how you've thought about those two pathways, and what does that mean to Prather's question about the definition of venture backable?
Yeah, I'm a big fan of Zoll's model and staying small and just rinse and repeat. We tend to believe that funds under 500 million still remain small, and I guess and the statistics show for sure that in that sort of small realm of sub 500, you see the best returns, and it's not that doesn't radically increase as you get smaller from there, but it does go down as you go up from there, on average, statistically. So I think staying small makes a lot of sense. That it's a very sophisticated question, and I appreciate the sophisticated nature of our audience here today because this issue of a fund returner is oft debated. And some people believe that you don't need fund returners, but if your mindset is you want fund returners as a simple rule of thumb when you're looking at a deal, which we tend to use as a rule, then you're absolutely right. Getting too large really just changes what you have to hunt for. Not getting too large, but by getting larger, you have to change what you're going to hunt for. And we have chosen not to do that and believe that any of the companies that we invest today in these different categories can have the potential to return the fund. And that's a great way for us to sort of keep things uh, focused, particularly when we're doing early screenings of deals. If they are just interesting companies that should get funded but are too small to return the fund, we'll often refer them to someone else.
And I think that piece is actually the kind of like tactical conclusion for a lot of founders here is that when you're fundraising, um, you might get the feedback that what you're building is not venture backable. And you have to sort of couch that feedback in the context of who you're getting it from. And, we saw this ourselves, right? So when we went out to raise our seed round, we started talking to folks about the subsequent future A. And one of my favorite investors, who's probably the best fintech investors in the world, they were like, okay, you need to hit these three metrics by the time you come back to us. 3 million in revenue, 60% gross margins, 3x year-over-year growth. And I was like, great. And I came back to them, I don't know, a year later. I was like, hey, we're like sort of close, not there, but close. And they were like, well, these numbers aren't the numbers anymore for us because of how much money we manage. And what we need to see now is 5 million and 60% margins and 5x year-over-year growth because that's what we're expecting for this thing. And so it's really just dependent on who you're talking to. And as you build that Rolodex, that pipeline of investors for your round, you have to be thoughtful. Like if you're talking to
100%.
Sequoia and you
100%.
can't tell a $100 billion story, you're not going to get there.
Yeah, and let's just make matters worse here, Dimitri. Like you could be talking to multi-billion-dollar funds and they may just sort of like you and like what you're doing, and they might rip you a check and say, sure, let's go for it. But I would still just check that carefully, at least really check the references for those people because they may say nice things to you and may give you $1 million or $2 million. But is that firm really going to be behind you? Are they really going to be there for the next check and the next check if you're not scaling into the dimensions that some of their other companies are? And therefore, I do think you as a founder can do the reverse, which is really target and right size to those people where you think your, let's say, your own conservative haircut of your big ambitious goals is going to hit. You think you can hit that. Is that going to be exciting enough for that type of investor? And I wouldn't ask them that question because their answer may be sure, but the reality is maybe a little bit different.
Mm.
Yeah, it's a good note that winning over your investor, building an authentic relationship is also that never goes away. Although having a lot of empathy for what their fund needs is an important one. We got a question from one of the registrations about how expected returns are changing, and especially for hardware or project and asset heavy businesses. when you think about maybe markets, industrial markets that have very strong exit multiples in M&A environments, if they are not fund returners, are you seeing funds, or does Obvious still underrate those if they can be above 50, 60, 75% of the fund based on those multiples? Like how much are you willing to look at M&A outcomes as a positive outcome for the industrial assets you might be willing to back?
Yeah, the answer is the bar gets really high. We'd have to believe something else, which is that maybe they're reimagining an industry. Take as an example, like um, cement or concrete, the greening of that industry, which I think is critically important. There are a lot of great companies trying to do that. Looking at that sector, which is extremely low margin, highly competitive, concentrated, difficult place to enter as a startup, and believing that there's going to be a strong exit in any scenario other than they have such extraordinary distinction in technology, a moat that they are going to be able to command massive margins and destroy, the incumbents. I think was really, really tough for us. We just couldn't get there. So we looked at M&A instead from those incumbents, and the history of that M&A track just wasn't very strong. And so we ended up not investing in that category, and maybe we'll regret that later. I just think we have to look really carefully at both the sort of out of the park success, which is always fun to do, and then the backups as well. And this is one of the reasons people love SaaS for so long. The buyers were willing to make maybe irrational purchases, or at least had the right to make extremely expensive or high multiple purchases. Places like the cement industry or concrete industry, you don't necessarily have that option to quote overpay for a startup acquisition.
Yeah. I think that's a fundamental takeaway that every founder needs to be calibrating to their specific markets and also making sure that they can quantify or narrate around what are intangible benefits on top of that. Can you strip a software component or a data layer off of those assets that might be acquired? I'll do a quickie and then pass back to Dimitri. Are you still thinking that this asset class is underwritten by venture capitalists for about 7-year holds, or has that horizon changed?
Uh, no, I mean, I think the average venture firm is a 7 to 12 year product. So I think that's been true from the beginning. People have investment periods for a fund that's, closer to 5 years or even these days shorter. But from a returns standpoint, people are expecting 7 to 10 and then sometimes 7 to 12. And then there's some folks that are exclusively deep tech focused who have slightly longer horizons, but I think that that's not that common.
I'm curious, Andrew, how are you seeing like VC attitudes shift towards having their companies take on other forms of financing as this dynamic changes in the broader market, right? So like if you're in cement, there's less VC money, you still need to survive. So are VC attitudes towards credit changing? Are they changing towards, equipment financing? I guess it's all just credit, right? So
Yeah.
like what are you seeing in the market?
Yeah, I think for sure, you know, um, and you all are proof of this, but the creativity in terms of alternatives is, I think, very well received. We had venture and venture debt for a long time, and that was it, you know. And now we've got a lot more or a broader set of solutions, which is great news. And I think that VCs are, in general, excited to have those alternative opportunities, but each one comes with its own risks. Even sort of plain old venture debt can be challenging for companies. And I think having investors, even angel investors or early investors on your team, on your side, on your cap table that understand how those trade-offs work is really, really valuable.
Yeah, and I think this is like there's a piece of advice that I give all the founders I talk to, which is that understand who you're asking for advice when it comes to capital. And oftentimes I think, you know, correct me if I'm wrong, but VC is an industry of strong opinions, often strongly held, despite the fact that there's not necessarily the relevant expertise to support that strong opinion.
Yep. Yep.
And so to your point, like ask the people who are giving you their opinion or their vote or whatever what their experience actually is, right? Because I mean, I can't tell you how many VCs I know who are like, I will never let my companies take on venture debt. Venture debt kills companies. And I'm like, well, actually, you as a board member and the CEO of that company killed the company.
Yeah.
You just shouldn't have taken on that debt, and
Yeah.
that's kind of on you. So, okay, that's really good. Yeah, I think for maybe what I would ask is like if you were to give advice to a founder who's trying to navigate that question with their board, and their board might not be as supportive as they should be. Are there things that you've seen founders do really well in those contexts where they can sort of convince their VCs that, oh, this working capital solution is actually the right thing for us?
Yeah. I mean, look, working capital and venture debt are different, or can be different. So I think founders that are extremely financially savvy, and not every founder is extremely financially savvy, um, tend to be very good at doing the math and understanding the real trade-offs. So if I've got to start paying interest right away, if I've got to draw it down, even though I've got 3 million in the bank from my VCs, and I've got to start pulling this debt right away, gosh, that like when I do the math, it doesn't really add up. Why am I doing that? And if you pull it all the way out through your repayment period, you a lot of times you will see that that's just not a great deal. And that's what some of those VCs are probably referring to. In addition to, gosh, when the company doesn't work out, it feels really bad handing it over to debt holders. But and that's where you get into, okay, whose fault really was that? But in the first order of taking on the liability, I think you just have to truly understand what it's going to cost today and what it's going to cost over the long haul. And not everybody does that very well. So that's something when we see founders show us that they do understand that or work with us to really understand it clearly, and yet we all still see the value in it. I think that's a great way to proceed. It's just proceed in partnership. But I think working capital that's secured in different ways, with receivables and equipment, that's different still, and I think has um, different trade-offs as well.
Yeah, I think the point you raised, which I think is really helpful, is like, look, as a founder, it is your job to understand the implications of any capital that you take on. And I think maybe the one thing that I would add to your advice is like, it's not just about what does this capital do or how do we repay it. It's also like, okay, if we take on this money, we're freeing up equity capital to do something else. And so coming to your board and saying, okay, well, if we just have the 3 million equity capital, this is where we get to. But if we take on this million of extra debt, this is where we get to. And obviously, here's how we're going to service it. And so I think that's good. Hannah, you want to
I mean, I think a lot
add
of
on
the
it?
lesson for this room is that that calculus has to start really early, is actually required way sooner than previously in the history of raising venture, right? Where it's like you could have used venture dollars to de-risk these strategies and understand them at scale. I think only ever now is it more important that you understand, tying a bow around everything Andrew was describing earlier, you have to understand the depth of the pockets of your current venture investors or the venture investors you're raising from in order to understand, does that match the profile of return to the fund math based on my exit outcomes? And if those aren't deep-pocketed venture investors, and I am going to have a dearth of capital at the Series A and B stages, what are my other mechanisms, and will my technology and cash profiles be able to earn the right of those forms of debt along the way? And if the answer is no, you're really caught in a rock between a rock and a hard place. And I think this has been, I think in the 2023 cycle was where we saw everybody calling that the valley of death. I don't really think there, I don't think it exists if the planning is done well enough in advance and
Yeah.
in partnership with your venture capital investors. And BB, the question to you then is really like, how does that conversation go down? So, like, if I'm approaching you as a founder seeking investment for the first time, how candid are we getting about your capacity to do follow-ons and the plan for debt or other credit solutions through the capital stack?
Yeah.
And how often is that coming up at the board level with your portfolio companies?
Yeah, I think the candid conversation that you don't have to have with the prospective investor is, will you definitely fund my next round? The answer is no. The answer is they won't definitely do anything after this round of financing. Would they like to? Would they have the capacity to? Hopefully, the answer is yes and yes, and that's what you want to find out. So I do think you can have a candid conversation about capacity of that investor. With regard to other creative components of financing that could be added, I really think that the best starting point is clearly stating goals and objectives with whatever amount of money you have. If it's, I went out to raise 20, I only got 10, what is 10 going to get me that's going to make me really attractive to the next wave of investors? And that is another really candid conversation. I'm a big OKR person, and objectives and key results are a great way to measure what should be financeable in the future. And what I would say is, like, where things get either let's be honest, or let's just not talk about it kind of zone, is when you talk about the haircut that you might want to put as a founder on your own stated goals. If I think I'm going to get 30 million in the next 3 years of revenue from zero, and that's what I've told everybody in the funding pitches, when we sit down and say, okay, but like with this money, what if we only get to 15? How's that going to look? That's a very, delicate and vulnerable conversation to have, especially before somebody's made a commitment. But I do think that for both parties, or I guess I should say, I think a lot of your investors or prospective investors are thinking that already in their heads, just as it's our nature to sort of plan and figure out, okay, in the downside, what could happen. So find a way to have that conversation with the prospective investor. Like, hey, what if this went like this? And I think it's going to go like this, but if it doesn't, where would you think we're going to be when we go out to raise money, et cetera?
Do you think that, maybe this is like, I've always wondered this question myself, is how much is like too much sophistication and scenario planning a bad thing, right? So is this
Yeah,
stuff you volunteer? Is this
yeah.
like, hey, we're raising five, but if we only raise three, here's what we'll get to? Or do you keep these scenarios in your back pocket? And then as investors ask, you're like, well, if we only raise three, here's what we'll do.
Yeah, I think it's back pocket. I think it's that's not too much to have done that work and to think it through. I think you could also answer the question, hey, we're raising five, but if we raise 10, this is what we'll do. Just to sort of show a spectrum of thought. I wouldn't
Both directions.
overanalyze it, but having that range of scenarios is a good idea. But really it's more just to say, I'm, you know, I'm raising five so that I have an extra 9 months past the key milestones that I want to get, just in case. That is a great mindset. I'm padding a little bit, not because I think things are gonna not work out, but because sometimes they take longer than expected, and I want to be empowered and not be up against the ropes when that happens.
Yeah,
So oh, go ahead. You want to go?
you.
I go. Okay. So I think this actually transitions really well to this next question that we have planned, which is about how entrepreneurs think about use of proceeds post a raise. And I want to maybe add some framing concepts first, right? One is there's a lot of talk out there right now about like, oh, I don't need to hire anymore. I can just use AI. And I personally think it's mostly nonsense, but I'd love to hear your take on it. Two is like, are you seeing a shift in what people invest in on average in terms of, either types of headcount, types of space, like are people buying big offices or renting big offices? Like, how is the use of proceeds shifting across the landscape that you see? And is there anything about how founders should plan their journey post-raise that you would sort of advise companies to think about?
Yeah. Um, I mean, first of all, on AI, obviously it depends some on the type of business. If you're building a rocket launch company, you can use AI for sure, but it's not going to that's not going to be a one person company.
Yep.
I do think for sure, and we've seen it, AI can have a real impact and a very, very positive impact on people's ability to start companies with a smaller staff. And I think scale, we'll see for how long and to what size, but to scale those businesses as well with a smaller team in the first couple of years. And I actually think that's very exciting and holds a lot of promise, really in a lot of different areas. We have a number of hardware companies that are able to do more with less because of the advancement in the tools. So that said, expectations have gone up as well, as you talked about earlier. And so I think that the use of proceeds conversation isn't that different than it's been in the past. And I think, what we're talking about is where does it get us in terms of milestones of team, but really more in terms of revenue and customer traction. Maybe depending on the stage, it turns into margin, et cetera. But that most of them have not changed that much in terms of the impact.
Yeah, fair. And I think that uh this I guess like how has buffer changed for you in this environment? Chelsea is asking a question here in the chat about, look, are we seeing venture success rubrics change when there's kind of this, you know, transition to bankability? And I think the answer is kind of like, unless you're meeting venture capitalists with the ownership percentages and the valuations that help them get return the fund math from your outcome, the answer is like, no, venture success rubrics are not changing. Um, but what does good like look like in today's market? Like one of the things I see a lot of founders doing is they know that like revenue inflation, metric inflation has become a real thing. It is no longer viable to have $1 million run rate for a Series A. That was
Yeah.
like a decade prior, right? So when you think about planning for buffer, going out to market for especially the naughty Series B stage with, you know, trying to have revenue metrics that make you top 10, 90th percentile of the companies out there in hard tech. How are you encouraging companies to think about using buffer for within their use of proceeds? Is that an extra 6 months of runway? Are you willing to upsize a round in order to help them accomplish that? Does that come at
Yeah.
a dilution? What's happening there?
Yeah. I mean, look, I think, first of all, valuations in a lot of cases have gone up. So you can raise more money with maybe not less dilution, but the same dilution as in the past. In some cases, that's happened. So I think the bigger issue is, yes, the revenue objectives that those goalposts have been moved out, but we should all just be talking about that's sort of your liftoff phase. The next phase is how are you differentiating? I think there's going to be a lot of S curve kind of companies that scale very quickly in revenue, but then plateau and then maybe dip down because they don't have differentiation. They don't have a real moat. And this is a real challenge with AI. I mean, of course, we're seeing it with like if you're a legal AI application startup and suddenly Claude is performing just as well as you, and yet like you've got a very lofty valuation. You might have had a big revenue ramp because you were the only game in town, but now one of the main platforms is coming after you. So those types of questions really lead to in the future financing, maybe not seed to A, but A to B for sure. What is your sustainable differentiation? And these are like age-old questions. They just happen to, I think, become more challenged in the age of AI or more difficult to answer in the age of AI. And this is one reason that deep tech and hard tech, meaning physical I think are going to have a real resurgence because they are much more defensible in many cases than just a run-of-the-mill, at least AI that doesn't need to be trained on proprietary data sets.
Yep.
Could not agree more.
The pendulum always swings, but to some degree, yes, these new halo, heavy asset, low obsolescence, things can be attractive when the entire market is moving in the other direction to investors. Remember, investors diversify, and you can sell that, right? We're going to shift into a little bit of a section here where I'm going to pose questions. Hopefully, we'll move them a little bit more rapid fire. But Andrew, I'm going to pose some questions as if you're my board member and we're just directly asking you, what do I do? Um, and how should I react to these things? So you're on the board. Let's say a former lead investor is sitting out my next round. Is that a bigger red flag to my downstream investors in this capital environment than a down round itself?
Uh, it is a big yellow flag that you have to address. Is it bigger than a down round? It depends on the magnitude of the down round. But I would be surprised if an investor said, we're going to sit it out unless it's a down round, then we're in. That would be a little bit weird. They're diluting their previous shares. But it also may happen that they say we're going to sit it out, and then other investors around the table say, if you do that, then we are going to have to fund it ourselves, and then we would be able to take more shares because of that, and you might be really diluted. And though that earlier investor might come back around after all. But I think that if you separate those two questions, this is the first question, is it a yellow flag, red flag to future investors when an insider sits it out? And the answer is it's something you have to manage. It doesn't have to be a red flag, but if the red flag is they can't stand you, they feel like they made a mistake, and they wish they never gave you the money in the first place, that's an issue because they're going to possibly tell that or at least insinuate it to somebody who asks. I don't know, like, that would be a disappointing scenario. It's not common in our world, but um, the more likely scenario is they put all their chips in the first round and said we're going to max out here because this valuation was high, so we don't have any reserves. Or they said we have a different reserve strategy. There are certain firms out there that really just only invest once, and they are pretty clear about that with founders. So it doesn't have to be a yellow flag. It does have to be explained. And I think the key there is build uh, listen carefully to that investor, figure out what's really going on, and make sure that you and they are on the same page about how you're going to explain that to future investors. They are heavily incentivized for you to get funded. If there is like literally a relationship problem, you have a bigger issue there. And so of course, goes without saying, but stay on great terms with your investors. It matters a lot in times like that. And there may be times when you think, well, I've already got their money, or, I don't like them anymore. And even if that's true, you might want to work through it.
Okay, let's say we're going out to market to raise a Series A, and we have, putting price and terms aside, we have a prospective lead who's a generalist, and we have a prospective lead who's a specialist in what we do. If you had to pick one, which and how would you decide?
Series A,
Sure. Or seed. Oh, does it
I
matter?
like I like specialists early on, or I like people who are going to give you something very specific. And this is maybe to another question, but I would definitely say pick the person before you pick the firm. I think that a common mistake is just, hey, it's a big brand, it's a fancy brand, and Obvious has a great brand, and I'm proud of it. But I think it's more important that you really look at who the person is who's going to be your board member, because having a very junior or unknown or person without a reputation at a big fancy brand may not be helpful. If they happen to have incredible background that's very germane and they are actually they were brought on to that big fancy firm to be a specialist, maybe that's good. And maybe early on that can be a super valuable sort of person to have in your corner. As you scale, it should be the case that more and more generalist firms are interested in what you're doing. And the way I would put it, at the seed, it is just the team. I mean, for the most part, people are looking at the team. That's the way we think about it. Team, and then over time, tech, you know, timing, these things start to show up. And then by the time you're late stage, it's really the team will matter, but it's what the team has built that turns into numbers, which turn into an economic view of a company and a vision for sure. But it's much more by the numbers at that later stage. And that's why generalists can play. And that's, ultimately leads to the public markets where it's the generalist fund of all generalist funds. It's a very retail world out there, and there will be analysts and others who will look at the companies from a specialist lens, but it's retail investors making the decision at that point. So think about that spectrum where you go from hyper specialist people who will really appreciate you and who you are and want to know about your vision, your background, your motivations. And then over time, if you're being successful, you're moving more and more toward a numbers driven world. Those people will appreciate the vision and the values that you bring to the company, but they will equate those with your financial success, or they should. They should say, this company is wildly successful because of the core that started with that incredible founding team early on.
What, first of all, I think all of that is super salient advice. Thank goodness we're recording this. Second of all, I need to raise my next round. The dynamics are solid, but both kind of existing investors are asking about, and new investors are seeking some form of an AI component to this business, and it doesn't resonate or really fit with what I think, what we founders think is the core revenue driver and priority of product for this business. Should we pivot? Should we be entertaining this? Are we gonna miss out?
I mean, I'm sort of surprised that I think we've only used the words AI like four times, five times in this conversation.
Pretty good.
Um, uh, I think this is pretty straightforward. Just lead with authenticity. And I'll say this because it's the right thing to do, but also just tactically, practically, BCs can smell it a mile away if you're not. So don't even try. The amount of times we've seen things get sort of repackaged to look world positive because that's what we care about, or to look like it's AI because somebody told them at, YC or something, you have to be an AI company. But they're not. It's just not a great look. So what I would say instead is I think AI is really important right now. I think, I'm fully red pilled. I believe it's a big part of humanity's future. I think everything's going to be fine, pretty much. So we embrace it, and most of our founders are embracing it in some form or fashion. So I wouldn't suggest burying your head in the sand and saying, I got it worked out. I'm using 10-year-old, concepts and technology, and it's all going to be fine. It's probably not if that's your mindset. We don't see that often. But I would say if you are making a electric maritime solution that doesn't need a ton of AI, but has incredible applications, dual use, or doing something cool with climate work, meteorology, et cetera. I think that those companies should just say it outright, like walk in and say, look, or really ahead of time say, we don't use a lot of AI, and I hope that's okay. Or, here's why we think this can be a multi-billion dollar company without being an AI app layer product, without having a big piece of that platform. So, but I do think it is decreasingly common that we hear that. Usually, we just did a autonomous driving company that has a lot of AI in use for machine vision. And we just announced an investment in Grit Robotics, which is a robotics, deep tech, hard tech company that's working in construction and large scale energy development projects. And yet they use a lot of AI in the picking and placing of solar panels on a solar farm, as an example. So there are, I think that you should think of yourselves in that world if you're doing anything that uses software or machine vision or any kind of reinforcement learning at all, and explain how you're doing that in a very modern stack. And then in the case that I'm not coming up with a great example for, where you're really not doing it and you really don't need to. I mean, I guess, I just heard about a really cool new way to generate carbon fiber that's much more sustainable. It doesn't really need any AI, but it could be a very valuable company.
Yeah. If I can take 30 seconds before Dimitri dives in, I have two anecdotes that I think represent this one that define authenticity to what you're speaking to, Andrew. One of a company I was chatting with, they said like, look, we're in the graphite space, right? Carbon fiber, some kind of commodity product that has huge implications across many different industries. And they were like, we need to include a slide in our deck that talks about the way that we're leveraging AI for large, data processing and especially to accelerate the rate of learning through which we're doing material testing and also how we're using AI in our general tech stack. And I was like, absolutely not. We are not taking up deck space for that. I'm sorry, but that's the baseline. Like that AI is enabling your workflows of AI products that you're primarily not creating or selling, right? Like that is the baseline. It's the new normal. And honestly, if your investors ask about it, you can speak to it, but it should be expected, frankly.
Yeah.
The second example was a conversation with a friend of mine in the electric vehicle charging space. And with distributed chargers everywhere and the way that they are managing energy and the contracts that they have with large customers actually has a unique opportunity for edge compute and being able to sell compute to
Yeah.
both within electric vehicles and on the
Yeah.
chargers themselves. And we had a deep conversation about pivoting and whether or not this is just gravitating into the dark hole that is, the black hole that is AI,
Yeah.
or whether or not there are some fundamental business tenets that allow a loss leading product. Theirs isn't loss leading, but for example, a loss leading product like electric charging to allow you the distribution to then be selling compute
Yep.
on the back end. And the answer there was a pretty obvious different side of yes, embrace AI because you are finding a fundamental margin driver as a result of a new product line, and that is worthy of a potential pivot and consideration. And absolutely, honestly, our conversation was you should remake your deck and start talking to an entirely new set of investors
Yeah.
about this
Yeah.
opportunity. And I hope this audience sees that there is a commercial difference between the pitching AI and your company associated with the two of them. Anyways, over to you, Dimitri.
Yeah, I think if you're all birds moving to AI doesn't make sense. Maybe it does, depending on how bad your core
Yeah.
business might be and how much cash you have on hand. Andrew, I'm curious, are there like I think that sometimes board members over-rotate on certain KPIs, where they're like, "Oh, we really need to measure this," or "This is not performing the way it should." Are you seeing any kind of like trends around things that people focus on now, which probably in the future won't really matter? That question makes sense.
Yeah. Yeah. Of course. Now, I think I've occasionally over-indexed on, I would say, too many measurements,
Mm,
not one particular type or another. Uh, but I think I'm not seeing anything like, there were a bunch of SaaS metrics people used to use all the time and try to adapt to other fields that I think probably were not necessarily appropriate. When you're talking about um, CAC for recruiting of EV charging fleets or something. It's not really the way that business works. And so that might be a sort of a SaaS investor getting confused about how to measure something in a field that they're not that familiar with. So that does happen where you have people cross over and don't really know, how to measure a hardware company when all they've ever done is software. So I've seen stuff like that happen, but I don't see a trend like token use per engineer or whatever, which I think had a moment for about 5 minutes, a month ago.
thank
But
God.
yeah, but we're not seeing that at the board level. Are you seeing that?
Um, I mean, I think I would say that I have often seen boards ask people to report on things that don't make sense. I think it does come from this place of, oh, I'm a like you raised a pre-seed round and I was your biggest angel, and so you decided to give me a board seat. Now I'm like showing up asking you for, what's your ARR when you're selling hardware, right?
Yeah.
I think the other thing that's happening, which sort of drives me up a wall, is that people are doing really creative KPI reporting. So they'll be like, oh, we had this many sessions of our AI products, so now we have ARR. And it's like, no, that's not really how that's
Yeah.
defined. And so I think maybe the thing that I would say is like, as the CEO, you have a fiduciary responsibility that you need to consider when you report metrics, and when you take advice on what metrics you report. And if an investor is telling you to report certain metrics a certain way that may not actually be representative of reality, you need to ask yourself whether or not that risk is worth taking. Because the moment you report those metrics to other investors and they ask you questions that you can't answer, you could be in legal trouble. And so
Yeah.
you want to make sure that you are actually confident in what you're reporting and why, and you're not doing like weird fuzzy math to accommodate a board member.
100%.
I'll go off script for our next question slightly.
Whoa.
Andrew. Whoa. Andrew.
I didn't know there was a script, so yeah, good.
Series A stage, board level reporting. What is the conversation? How quickly should I be mapping out a pathway to profitability as default alive?
Oh, okay. So I don't know what Series A means anymore, or Series Seed or whatever. So and the answer for profitability is just so different for every company. Again, if you were building a space launch company, default alive is not really, I don't think it's profitability. It's like default fundability or something. I mean, Commonwealth Fusion is not thinking like, maybe this current round of $1 billion, but before that, they weren't thinking this one will get us to profitability, right? They weren't thinking that for the last 10 years. So they had just a different kind of definition of what success was going to look like. Um, so I think the question you're sort of asking is what are the things we should be measuring when, or how soon should we get really sort of grown up about fancy OKRs and measures? And I just think it's a conversation with you and your board about how mature really is the company. And if the company is like, hey, we're just trying, I have a great startup, an AI startup in the energy space, and they're still trying to figure out exactly what the customers want that's going to be highly scalable. And so saying to them that you should have this and this sort of broad metric of ARR and gross margin and things, it's just not worth the time that we would spend trying to come up with what the measure should be. But product market fit measures to say, uh, is there massive customer pull? And you can measure that and you can sort of describe it. Are they telling you what they want? You're building it, then they're saying great, and then their usage metrics go through the roof. That's something that you could measure. So if, on the other hand, you have built something that is really just taking off and people are very, very excited about, you might have much more mature measures of ARR and, sort of traditional SaaS metrics to see what, how you're doubling of your revenue over what period of time, how you're expanding. Even for a company like that, you may be much more interested in let's measure our ability to hire really productive salespeople because the thing is just it's working, but we need to get out there. And if it was enterprise sales, it's still a human thing. There's a lot of different ways that you would measure things early on that are not cookie cutter and may or may not align with how they would look, 2 rounds from then.
Yeah. I appreciate that a lot. And I think some founders get caught between board members who are asking for metrics that define that fundability of the next round while those metrics and goalposts shift. And we had a conversation about what those metrics actually are. But also, I guess the question is a little bit about like how much kind of optionality are boards asking for to have a game plan toward default alive, even if those metrics do not attract the downstream funders as anticipated. And I guess the answer to your question or the answer you were parlaying there is a little bit that it depends on the capital intensity of the business. A nuclear build out is just going to have a very different profile. So that's fair.
Andrew, I'm curious if you, let's say you're on the board of a company that raised at like a 2021, maybe early 2022 valuation, and now they have to raise some money. And I'm the founder coming to you. Is it better to do a down round, a bridge? I guess are they the same? Like, how do you think about the messaging behind, oh, we haven't hit our Series B metrics, so we can't raise a formal B. So what do you call it? How do you think about it?
Yeah, I don't know if there's a right answer there. I think you do what you got to do. I mean, when I lay out OKRs for teams or work with them to determine what they are, I usually just have um, we just a line that you will not have less than 6 months of runway before you have received a term sheet for the next financing. And I just want that box to be green every quarter. Yep, we still got at least 6 months of capital or a term sheet. And that is just a constant reminder that your number one job as a CEO is don't run out of money. And if you ever get close to that point, you have to start taking actions, some of which may be uncomfortable, to put yourself back in that position.
Is okay, I maybe I'll poke at this a little. Is 6 months really the right number anymore? Or is that just true for your like portfolio where, maybe it's like a different caliber, right? Because my sense is that, I don't know, fundraising especially at seed, but probably at Series A and even later, it's taking a lot longer than 6 months on average.
Yeah, I mean, I'm just saying that you have to have a term sheet before you get to the 6 month mark. Not that
Mm.
you should start financing.
That,
Yeah.
yes.
Yeah.
Yeah. What would you
You,
say is the average you're seeing for how long it takes to raise a round?
uh, I,
Or it
I
really
don't think,
varies.
yeah, I just don't think I don't think it's that helpful an answer because average just doesn't matter. Like company A will be so radically different than company B that the average of the two of them is advice that neither of them can use. So I don't know. I mean, some companies take a year, some companies take 3 weeks.
Are you tracking that as a funder, the pace and capability of your team to
Not
raise?
statistically, not statistically, but we can feel it. Everybody can feel it when things are not going well. Um, so it's something we keep in mind and watch, but we definitely are tracking runway and where they are relative, to the
Yeah.
cash out date when it comes to fundraising.
Yep. Well, let's take a similar tone, but move it a little bit more into what are some of the other things you're seeing that founders can action? What do you think are some of the most common mistakes happening in the boardrooms where founders are presenting an idea and you're consistently saying, hey, I need you to adapt and be moving more in this direction. And if that's maybe on the vein of our last questions, is that they are too aggressive about their fundraising prospects in what you're seeing in the capital markets, and you're consistently saying, hey, you need to be a little bit tighter on burn management in order to afford that? Or what are the common mistakes you're consistently debating?
Uh, I don't know. I don't know if I'm seeing common mistakes across the portfolio. I mean, I think that if you have really honest, highly proactive communication or relationships with your board members, um, there shouldn't be like repeat problems because if there are repeat problems, somebody's doing something wrong. It might be the board member, the investor, and it might be management, where it's a lot like marriages or relationships. You want to really understand what the other person is saying and be respectful of it and try to communicate about it to make sure that um, are at least, if not agreeing on any given topic, at least understanding it and willing to address it. And therefore, you shouldn't have repeat problems unless it's a repeat problem that you both agree with. Hey, we still don't have product market fit. Yeah, that's an issue. What are we going to do about it? Well, here's the plan, and it doesn't work. And then you come back at the next board meeting. That might happen. I mean, these things happen, but I don't think that you would. We certainly wouldn't. We would not let something go by twice without some kind of intervention where we said, "Hey, are we on the same page? Can we acknowledge that something's missing here?" Um, I think that that's just sort of the sign of or the product of a healthy relationship with an investor and a founder.
And I would say I think this is speaking from personal experience. Like we had a board meeting, two or three board meetings back, and I had like a really tense exchange with one of our board members, and it felt really bad. Like, it felt really bad, and part of I had talked to a few folks about it. They were like, just leave it. It's like not worth it, whatever. And I took the initiative and I reached out and I said, hey, this felt bad. We should talk about it. And we had like probably a 60-minute conversation, both about where she was coming from, where I was coming from, why it felt bad for both of us. And it like resulted in probably a fundamental improvement in the
Yeah.
trust in our relationship. And so I would say that, especially with board members, like you need to build the kind of relationship where you can have that conversation. Because if
Yeah.
you're walking on eggshells with a board member, that's not sustainable long term.
Brutal.
Yeah.
Brutal.
And it will only get worse, right?
Yeah. And as I said earlier, it will come back to bite you for sure when you go about the next round of financing. Even if you've decided you can't rely on them for that financing, they've given up on you. A lot of damage could be done through a sort of open wounded relationship.
Yeah. Okay. Maybe like keep these to a sentence. But if you had to give a founder, I don't know, three pieces of advice for how they should navigate the next 12 months, what would those three pieces of advice be?
Well, I mean, there's sort of how to navigate life as a founder, and then specific to the next 12 months.
Yeah.
Okay, specific to the next 12 months, I would say, yeah, watch the burn rate, watch those sort of the changing dynamics in the market of what people, what is the definition of value, and then for sure, look for those, I think increasingly look for those points of sustainable differentiation versus your competitors. Because if you have those in this new AI enabled environment, you already have something that a lot of other people don't, and it will be perceived as really valuable.
Yeah. Great.
What is one thing founders should start doing that they're not? And what's one thing that founders should be maybe stopping doing?
Um, you know, this is just, I mean, everybody makes different mistakes along the way. And I was a founder for a long time, and I certainly made my share. But I guess one thing I would say that I think some people don't remember to take the time uh, to really focus in on your own team. You have to do 1,000 things at once as a founder, and we've been talking a lot about making sure you keep the lights on and the bank accounts where they need to be. But your team, even with the help of AI, your team is what's going to make the company successful. And I think a lot of people, some humble founders don't believe they have great management skills. Some believe they don't have time to manage or lead their organization. And I would say, if you really don't have the skills, you need to get them fast. And if you think you don't have the time, I'll bet you do. You got to make the time because it will come back to bite you later. But more importantly, it's just how you build a scalable organization. So if you're not doing those things today, I would find the time, make the time, and I would recommend doing it very, very consistently. So, a small example would be compliment some people across your team daily, only when they're doing great things. But somebody somewhere on your team is doing something great today. Let them know about it because you will find otherwise you're often just focused on when they're doing something wrong, which you also have to focus on. But celebrating the good and really showing people, especially with virtual teams, et cetera, I think showing people that they're kicking ass and making a big difference to the company is just gold.
I want to add to that. I think that one of the hardest things of the founder is to not just live in the firefighting, like all because that's all you do, right? Eventually, you have talented people who are handling most of the things, and the stuff that you see are the problems. And not only does recognizing your team when they are great make them feel good, but it makes you feel good. And you need that too, right? Like, because if all you do is you live in the shit, you're gonna feel like shit. And then that's gonna further translate. And so I think that recognition, like that's one of the really powerful things you can do that also helps you as well. All right. In one sentence, do you think venture will look the same as it does today in 5 years, or do you think it will change?
Well, I mean, I think it's easy. It's definitely going to be different than it is today because I say that only because it was different 5 years ago and different 5 years before that. This is a constantly evolving sport, and it's a humbling one. But I think that I believe venture is going to exist in 5 years and will play a crucial role in doing what it does in massively enhancing the innovation economy. And I think that you may see things be different in terms of the types of collectives that come together to form venture firms, the way people think about valuations, whether people just start increasingly sponsoring individuals at that pre-seed range. And then you might also start to see things like public vehicles that are playing more in venture. So I think it'll evolve, but the idea that venture is here to stay in terms of funding early innovation, especially in the US, but hopefully around the world as well, I think is something I believe in.
Awesome.
Amazing. Andrew, thank you so much for the time and insights. This was
Right
awesome.
on. Great to see you
Virtual
all.
virtual fire included. Yeah, likewise. We'll do
Take
this all
care.
again soon and we'll send out the recorded notes to everyone when they are ready. Thanks.
And we will be announcing our August event probably next week. So if you are not a subscriber to the calendar, you can do that in Luma. We'll also share the notes, all the usual jazz. Thank you everyone for joining us today. This was awesome.
Thank you.
Take
Thanks,
care.
Andrew.
Bye.